Welcome back to All Things Money. We're going to finish our show tonight, as we always do, with some questions from our listeners and viewers. But before I do, a lot of the information we talked about previously on the healthcare reform came from a CCH tax briefing. CCH is a big company that produces information and resources for people in the taxation industry. And I think we have an Adobe file of this. If you'd like a copy, feel free to email me at allthingsmoney@dlblain.com if you'd like to get a copy of this overview of the Healthcare Reform Act. Or if you have any other questions, feel free to give us a call at 633-0107 or email us at allthingsmoney@dlblain.com. So our first question comes from a viewer. Actually, it has to do with someone last week. Our question was about someone leery of taking a deduction due to an audit. And interestingly, this week, some new statistics came out from the IRS on audits, and so we thought we would do a follow-up to that question this week since this new data came out. So this is from fiscal year 2009 from the IRS. There were about 138 million required tax returns that were filed. Of these, about 1.4 million were audited, or roughly 1%. And so what I'm going to do in answering this question, it will just take you back to last week. Someone asked a question about raising a red flag because of an audit. And yes, the IRS uses a computerized modeling to determine somewhat of who they would audit. But the answer last week to the question was, don't be afraid to take a legitimate deduction for fear of an audit. And so what I'm going to do today to follow up on that question is to help demystify some of the things surrounding an audit, as well as give you a few tips on how to possibly keep from getting audited. So about 1% of all returns that were filed in fiscal year 2009 were audited. Of those, about 36% had the earned income tax credit claim. And this is important, especially for viewers out there or listeners that are in high income brackets and are afraid of getting audited. Fully 35% of all the audits for the earned income tax credit. And I'll read to you what that is. It's the earned income tax credit is a refundable credit for low income earners, people that make less than say $48,000 with 3 or more qualifying children, or $18,000 with no qualifying children. So it's a refundable credit, meaning that if you owe no tax and you qualify for the earned income tax credit, the IRS will actually send you a check. Even it's not a refund. You didn't owe any tax. They actually send you a check. And in some of the low income communities, this is a huge area of abuse. Many tax preparers, unscrupulous tax preparers, get their clients to falsify their tax returns, to send in. Of course, they collect hefty fees from these refund anticipation loans, and they defraud the government. And these tax clients, they're not taxpayers because they don't owe any tax, but they get these big checks back from the government. And so you hear a lot about the audits of the high-income taxpayers. Well, 35% were for low-income taxpayers on this earned income tax credit. It's a huge, huge area of abuse. So right there, that knocks out about 36% of the audits for low-income taxpayers. Another thing to remember is only about 23% of all audits were conducted by an actual human being, an IRS tax agent, tax compliance officer, and tax examiner. Those are three. I'm not going to get into that, but those are the 3 different types of people that are at the IRS. The remainder of the audits, the majority of the audits, were what are called correspondence audits, where you simply get a notice in the mail that says, "Oh, this figure did not match up with our records, please explain." And so it's a very non-threatening thing. Well, the letter may seem threatening to you, but for someone like myself that sees them all the time, it's really a non-event. It happens all the time, and you just respond to it and take care of the problem. A couple of interesting statistics for people that reported between 200 and a million of income and no business activity, about 2.3% were audited. For people with adjusted gross between 1 and 2 million, about 5% were audited. The bottom line is if you don't own a business and you make less than, say $200,000 a year, your chances of getting audited are extremely slim, unless you're taking the earned income tax credit. On the other hand, 100% of the companies that have over 20 billion in assets get audited. Between 5 and 20 billion, about 50% get audited. So if you're a corporate taxpayer with big assets like Coca-Cola or Exxon, they get audited every year. So I just wanted to demystify a little bit of that. We've got time, I think, for one more question. A viewer sent me an email and he said, asking what the CFA designation that appears on the screen after my name means. And that's a great question. CFA stands for Chartered Financial Analyst. And the CFA designation is awarded by the CFA Institute, and it's the only globally recognized investment professional designation out there. There are about 99,000 CFA charter holders in about 134 countries. To receive this designation, you must pass 3 6-hour examinations over a minimum of 3 years, covering topics from accounting, quantitative analysis, stocks, bonds, derivatives, options, real estate, anything to do with investing or accounting that you can think of. The CFA program, it has about each exam has about a 30 to 40% pass rate. And so if you look at the average number of people that start the program in year one, only about 7% of the people that eventually pass all 3 tests and are entitled to use the term or the designation CFA. A lot of CFAs work on Wall Street or at large banks and mutual fund companies. I happen to enjoy working more with individuals, and so I work with individual investors. Some famous CFA charter holders include Sir John Templeton of the Templeton Fund Company, Bill Gross of PIMCO, the world's largest bond fund manager, and Bill Miller of Legg Mason, who had a string. At one point he beat the S&P 500 like 15 or 20 some years in a row. So that's what the CFA stands for. Well, that's all the time we have for this evening. I hope you'll join us next week when we have another show. For All Things Money, this is David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.